All right, guys, should we get back? We can get back to this. So today we had quite a few um, things that you know would be out of your comfort zone. New things talking about inventory. We spoke about conflicts. Well, conflicts would still be somehow something that you can relate to, but I know the last lecture about inventory was pretty much very new to most of you. I sent the link, so I'm seeing people coming on. Um, Once we reach 10 people are going to start. And we're going to do now another piece of another lecture that'll be somewhat new and strange for you all, which would be financial statements. Um, if you open up your package of documents that Dr. Maraj would have sent, I want you to open up the PDF on financial called Financial Lecture 2, and um, you can open up depreciation. Now, I think I did a PowerPoint presentation that would have helped to condense this financial lecture in PDF, and I will email that to I can email it to Dr. Maraj, or I could try to see if I can WhatsApp it. No, I don't think I could WhatsApp it. I'll email it to Dr. Maraj to send to you all to put up for you all to have a look at as well. Because I don't think he had this. This is one that I did last year, fresh. So the two lectures that you're pulling up is Financial Lecture 2, which is a PDF file, and you're pulling up um, Depreciation, which is a PowerPoint presentation, and I will send this other lecture to you later today. Okay, so let's go. So financial statements. Financial statements are the accurate picture of the financial affairs of a company within a given year. And I'm going to start putting into the chat important things one time. Within a given period. Now, we generally say, we generally use 1 year as the financial period. It could be any time, it could be any amount of time as well. But generally accepted accounting principles, 1 year. These statements are prepared using financial data collected by the accountants or the financial analysts of the company. So for small companies, and like for a small community pharmacy, or for any generally small company, you may not have an accountant collect the data and prepare the data, or an analyst hired to do that. You may have to use yourself or one of your staff that would be able to prepare the invoices, and enter the information, enter the data on the computer, and the accountant just comes in to pull that data and prepare statements. Right? So most of the data entry work, you don't need someone in accounting, you don't need someone in finances to do the data entry. It's a simple guide the accountant can give to prepare Excel sheets. So when they come in, they can easily get the information to create the accounts. These statements need to be reported prescribed by the following prescribed and accounting principles called the GAAP. And GAAP, I'll put it in the chat. GAAP is generally accepted accounting principles. Right? So this is a international standard by which persons use to generate financial reports, and the financial institutions and your boards would look at how the accounts are presented. Usually most boards have one or two persons who are experts in accounting and financial management. So there are four types of financial statements, for basic types of financial statements. Some of them may have slightly different names, depending on the type of industry that you're in, but there are four general types. And one is the balance sheet. Two, the income statement. Three, the cash flow or financial position statement. And four, the statement for changes in equity or changes in shareholders' equity. Let's get into the balance sheet. The balance sheet talks about what the business owns. What does this company own? What are its assets? And we're introducing that term one time, the assets. What are your assets? Secondly, the balance sheet talks or would present what are the company's liabilities. What does it owe? What does the company owe and to whom does it owe? It would also state. So I'm going to put that in the chat as well. Liabilities. And thirdly, we're going to look, it tells of what is left over. In other words, what does the company have as equity from its liabilities that is applied or taken away from the assets? So we're going to go to a formula, and you're going to see I'm going to hammer home this point a lot. Assets equal liabilities plus owner's equity. Remember this formula, please. Assets equal liabilities plus owner's equity. Assets are what you own. Liabilities are what you owe to people, to your debtors. And your owner's equity is what is the remainder of what you remain with when you take out your liabilities from your assets. So that's the owner's equity. Assets equal liabilities plus owner's equity. So in the balance sheet, let's talk about assets. Assets are defined as a valuable resource owned or controlled by the business at and acquired at a measurable cost. Measurable cost. Assets can be cash, money owed to the business, also called accounts receivables, and equipment. Assets can be further divided into current and non-current assets. So let's go over again. Assets are defined as a valuable resource that is owned by the company and is or controlled by the business, and was acquired at a measurable cost. It can be cash, money equivalents, money owed to the business, which is like accounts receivables, people who owe you, and equipment, infrastructure. Assets can be classified as current and non-current. Current assets are those that can be sold or converted into cash within the business year. Current assets can be sold and converted to cash within the business year. Example, your inventory, your accounts receivable. Non-current assets, or also called fixed assets, are items that cannot be converted to cash within a business year. Example, land and fixtures. Now, yes, sometimes you might be lucky that if a company is trying to sell land or some of its equipment, and yes, you might get it sold within a year, but generally speaking, land and other fixtures are not easily sold and converted to cash within a year. So assets, things that the company own or control, assets can be current and non-current. Account receivables, big part of your current assets, is what is owed to you, what credit you give to your customers, and if payment is also made by a third party. Now, the third party thing could be the insurance, health insurance. So, especially in the US, you have the insurance companies playing a big role in healthcare, and providers give out their service or give out their product to the patient, who is the second party, and the third party which is the insurance company, they are the ones that have to pay you. So that's third party payouts, and that's an example of an account receivable. Inventory is also an asset because inventories are sold and they are in your control. And inventories can be either supplies inventory, which is the consumables like your pen, paper, printer, ink. Those things are supplies. And your merchandise inventory is your stock for sale. I want you to appreciate that inventory is an asset. And later on, the reason why I'm putting this here because later on you're going to see how inventory turns into the COGS, cost of goods sold. But right now, inventory is an asset. And inventory can be supplies, and inventory can be merchandise. And of the two, make a guess which will be bigger. Supply inventory bigger than merchandise inventory? Make a guess. Can anyone muster up a guess which would be bigger? Let me see some answers. I know you all probably tired and want to sleep. Which would be bigger? Supply inventory or merchandise inventory? Someone throw it out there for me. Anyone? Melissa, merchandise inventory. Very correct. Merchandise inventory, usually, because it's your stock for sale, it's expected that you have a whole lot of stock for sale versus a whole lot of equipment that is just there to help sell your stock. So your stock, your merchandise or your stock for sale is usually the larger of the inventory. Remember those things, please. So on to liabilities. What does the business owe? And liabilities as well, just as assets, can be current and non-current. And as I mentioned, for assets, current liabilities are those that must be paid within the business year. And that can be accounts payables, accrued expenses, and the current amount on a loan. Remember a loan could be for 10 years. So the current liability of that loan is the amount of that loan that is paid for that year. Every year in your financial statements, you're not going to put the whole loan. You're only going to put what is paid on that loan during that year. And similarly, using the loan as well, non-current liabilities are those that are not payable within this financial year. They're put onto the sheet, but they are not due in your financial year of reporting. Remember, I said in the beginning, financial statements are reports on a company's finances within a given period of time, usually a year. So your assets, owner's equity. And the formula, as I said, assets equal liabilities plus owner's equity. So therefore, owner's equity is your liabilities minus your assets. Essentially, what is it that your net worth? What is your company's net worth? When you remove all your liabilities from all your assets, how much you are actually worth? Owner's equity can be invested capital, or it can be returned earnings, either profit or loss left in the account after the financial year. The other statement that we're going to look at is the income statement, and I hope that you're scrolling through the PDF that I asked you to open. So we just discussed assets, and now we're on to the income statement, right? Income statement. So the income statement is also called your profit and loss statement. It tells your net income, also known as your net profit, and your net earnings. So your income statement is your profit and loss statement. Net income is your revenues minus your expenses. Net income is your revenues minus your expenses. And what's your revenue? Your revenue is your cash and credit sales. Your cash and credit sales is your revenues. And what are your expenses? Your overheads. And now we're going to introduce the term cost of goods sold. We mentioned it in the earlier lectures. Cost of goods sold. Salaries is so your inventory, when it becomes sold at the point of the sale, at the point of sale, your inventory turns in from an asset into an expense. And when it is sold, it is now called cost of goods sold. Other examples of expenses would be your salaries, your rents, your utilities, payment of interest on loan, depreciation, insurance, advertising. So cost of goods sold is your beginning inventory plus how much you purchased throughout the year, and your ending inventory in December when you do your stock count, that is subtracted from your total of your beginning purchases, your beginning inventory, and your purchases throughout the year. That would tell you your cost of goods sold. Okay? And your cost of goods sold moves from being your inventory moves from being an asset to an expense when it is sold at the point of sale. And we have another formula there for you, cost of goods available for sale, which is simply how much inventory you started the year with and how much items you purchased. Both of those together is the cost of goods available for sale. And owner's equity or retained earnings or changes in owner's equity. Within the business year, what is left, what was withdrawn, and what was invested. And one minute there. Right? And the fourth statement is your cash flow, statement of cash flows, statement of changes in financial position, also called the sources and uses statement. Manipulating cash is very difficult, and hence a cash flow statement is considered to be a more reliable source of information about a company. So your cash flow statement is very important. I know immediately might think profit and loss statement or balance sheet statement, but cash flow statement is very important. And cash can be generated from three main activities. Operating activities that generate cash, your operations, your everyday sales. Investing activities, monies that you put out an investment in. You invest in certain things to get a return. And your financing activities, what financial tools you use to generate income. And the abbreviation that I want you all to remember is of how cash can be generated is OIF, OIF, and operating, investing, and financing. OIF, operating, investing, and financing. These are things that you can. These are things that are done that can generate cash. So we look at the different. We're going to move on to the accounting methods now that are done at times to do this financial reporting. So cash accounting is done at times where revenue is recorded during which cash is physically received. So you physically receive your cash and you report that as revenue. Expenses is recorded when cash is paid out, and it may not be the same period, which is, and this is not this is not commonly used by pharmacies for reporting. Accrual is where revenue is recorded when goods are delivered or services are rendered. Both cash and credit sales are recorded as revenue. Expenses are recorded either in the same period that it is made, or two, in the period in which the expense is actually paid out. Accrual accounting methods give a more accurate measure of net income. And we're going to, so let's just review. I just want to review, going back again, and I'm going to do over these financial statements because I know this is information that will be relatively new. So take home financial statements give an accurate picture of the financial affairs of a company given in a given year. Right? It uses data that is compiled. Accountants use the data that you compile to create these financial statements that are done in the generally accepted accounting principles. 4 types of statements: balance sheet, income statement, cash flow, or also called changes in financial position. And the final statement is the changes in shareholders' equity. Understand that assets equal liabilities plus owner's equity. Assets equal liabilities plus owner's equity. What are your assets? What are your liabilities? What is your owner's equity? Assets can be defined. Just 1 minute there. My sincere apologies for that. I just had to clear up something. Okay, good. So your assets can be current and non-current. Your liabilities can be current and non-current. We say current meaning things that can be converted within a year. Assets meaning converted to cash within a year. Liabilities mean paid out within a year. Non-current are things that cannot be done within the year. So the current and non-current deals with the specific period in which things are being reported. Accounts receivables and inventory, they are both considered assets. And I mentioned just now, your inventory moved from being an asset to an expense when it is sold. And in your inventory, which is an asset, because converted to an expense called cost of goods sold when it is actually sold. We said inventories can be supplies or merchandise, and supplies are usually the lower value of your inventory. Merchandise is certainly the bigger one. Owner's equity is essentially your net worth based on liabilities being removed from your assets, or liabilities being applied to your assets, and what is your worth net. Income statement, a very important statement, tells you the net income. Income statement tells you the net income, which is your revenue minus your expenses. Your revenue is your cash and credit sales. Your expenses are all your overheads, which includes rent, salaries, utilities payment, loan payment, depreciation. Cost of goods sold is an expense when your inventory is sold. Spoke about the cash flow statement being very reliable. We talk about three ways in which cash can be generated: via operating activities, which is you sell and you get a cash; you invest money and you get cash; you do certain financing activities and you get cash, right? A financing activity can be, for example, Courts and Unicom and a lot of other companies as well. They are doing hire purchase plans on their items, and they're actually becoming small lenders as well. So that's financing. And we talk about cash and accrual accounting methods. Um, Accrual meaning revenue is recorded when goods are delivered or services rendered. And this is the one that pharmacies would generally use. So before we go into depreciation, let me get a little feedback from everyone. Any questions on what we've done so far based on the financial statements? Questions from anyone? Because we're going to go into depreciation now. No questions from anyone? No question. All right, Tracy, thanks. Right, so going into depreciation, and you can open up your. I've condensed the depreciation PDF that you have there. No, the depreciation slide presentation you have there into 4 main slides, and then we'll go through them. So depreciation is the process of systematically and rationally determining how non-current assets are recognized as an expense. So depreciation applies to non-current assets as an expense in each year. Right? And your non-current assets would be your equipment in particular. Depreciation, please note, does not apply to land. Why does depreciation not apply to land? Can anyone tell me? Why would depreciation not apply to land? Anyone, throw out an idea why you think depreciation would not apply to land. And let me go back to the definition. Depreciation is the process of systematically and rationally determining how a non-current asset is recognized as an expense each year. Non-current asset being, like, for example, equipment. And we can go all the way back to look at what your non-current assets are, right? Non-current assets are fixed assets that cannot be converted into cash. So, and we say it doesn't apply to land. Let me see if I get some answers from you guys. Why? Nobody? Value increases over time. Yes, yes, land value increases over time in Trinidad and Tobago. There are other places where land value may not increase because of, let's just say, war, viruses, things that render the land useless, earthquake prone. But the reason why it doesn't apply to land is because, simply put, land don't rotten, land don't go bad. Generally speaking, right? Generally speaking, land does not experience wear and tear. So depreciation does not apply to land. Thank you, Melissa, for your suggestion. So we need to know some things when we are calculating depreciation. One, acquisition costs. How much did it cost to acquire the item? And importantly, I want you all to remember this. How much does it cost to make the asset workable? So I'm going to put that in your chat. Acquisition cost. A is acquisition cost, which is the cost to acquire and cost to commission. And I use the word commission simply to mean how much additional cost is there for you to make the asset actually become utilized. So it's one thing to, for example, buy the equipment, but you need to people always fight. So I guess it's valuable. Reese, that's a yes. I know people like to fight for land. I know that. I know that. I know that's a fact. But they like to fight for land here and in other countries, but particularly here. So yes, that makes it valuable. So getting back to what I'm saying, the acquisition cost is how much you pay for the equipment and how much you pay to get the equipment to work. Two amount of payments that you have to make, both together is called the acquisition cost. And I will be putting that in your exam so that you need to remember the acquisition cost is how much you buy the item for and the cost it takes to get it to work, whether be it the cost to run electrical, the cost to run plumbing, the cost to do training. All of those things are part of the acquisition cost. Remember that. All right, Reese, you made us laugh for the morning. Next, we have N, which is the useful life. So the things we need to know for depreciation: A, acquisition cost. Well, C, sorry, acquisition cost. Next is N. How many years it's going to take for the life of the equipment to be useful? 5 years, 10 years, 6 years. The useful life of the equipment, N. Next, we're going to need to get the residual or the salvage value. So we buy a piece of equipment, it lasts for 10 years. After 10 years, how much is it worth for sale as scrap or for repurposing? That's the residual or the salvage value. And your depreciation expense is the cost of the acquisition cost minus the residual value. Your depreciation expense is the acquisition cost minus your residual value. So let's just say, for example, we paid $10,000 for a piece of equipment. After the equipment can last for 10 years and work well for 10 years. After 10 years, we need to get rid of it. When we get rid of it, we sell it off to a scrap iron dealer, or we sell it off to a company who's doing research who wants all equipment, and we sell it for $2,000. Therefore, our depreciation expense is the cost, which was $10,000, which bought it. We didn't have to pay anything extra to get it to work. It's a plug and play, so no cost to make the asset workable. And we sell it for $2,000 at the end of 10 years. So therefore, our depreciation expense is $8,000. And the depreciation rate is usually 1 over the useful life of the equipment. All right. So the methods of calculating depreciation, we have each year the depreciation expense. If we're using straight line, there are two types. There is straight line and there's accelerate. There are two types or three types? Two types, yes. Straight line. Every year, the depreciation expense is the same value. So we say that the depreciation expense was the acquisition cost minus the residual value. And in our example, we use $8,000. So $8,000 now would have to be divided into 10 years. So every year, that figure, which would work out to be, I'll get it here, divided 10. So that'll be $800 every year would be applied, would be applied to your financial reports as a depreciation expense for that equipment. Right? And in some financial reports, they have to be very detailed. So that's straight line. Each year of depreciation expense is the same value. The accelerated method is a little different. Earlier years have higher depreciation expense than later years, which you can appreciate. You have a brand new machine that is working really great. You're going to get the best out of that machine in the earlier years, and in the later years, things are going to happen, and the quality of the product might not be the same. Although machines that ought to be calibrated to produce the same amount every year and the same consistency all the time. And the accelerated method uses two things: the sum of digit years, which is the depreciation expense, multiplied by the number of years over the cumulative sum of all years of life. Sounds a little complex. Look through your PDF and you'll see the example that's given, and I can pull it up now. Let me pull it up now. Right, so depreciation expense. Depreciation. So the straight line method is very easy, and you can see all the letters there. So the accelerated method, sum of digit years. Look at the example. We make a cumulative sum of all the digit years. In this example, the useful life of the equipment is 5 years. So the sum would be 5 plus 4 plus 3 plus 2 plus 1, which is 15. And n is the number of years of useful life of the equipment. So it will be 5 over 15 multiplied by your depreciation expense. And in this case, they use the depreciation expense of $30,000 over the 5-year period. So, and that now you can plug it in and you can apply the depreciation expense that it can be calculated for each year. If you look on page number 14 of your PDF lecture, you will see where each year there's a different amount that is applied to the, the, the depreciation as applied to your financial reports, right? Remember, your depreciation expense is your cost minus your residual value, right? And that remains constant. But the depreciation expense is what the depreciation, sorry, the depreciation is what is changing every year. That would still give you the total $30,000 depreciation. However, each year it would decrease in how it is applied. The other method on the same page 14 is the double declining method, where let me get the PowerPoint here. Right, the double declining method, where it looks at the book value. Now, you're going to introduce a term now called book value. The book value of the item multiplied by double the straight line depreciation rate. So so we need to know how is book value calculated. Book value is calculated by subtracting from the acquisition cost the accumulated depreciation. So look at your PDF. Let's look at the PDF here, and you would see, right, so we're looking at the example of double declining method. I hope everyone is looking at their PDF. So book value here is determined by your accumulated your depreciation values are on the fourth column, sorry. And the fifth column is your accumulated depreciation. So book value is, as mentioned just now, book value is the acquisition cost, which is C, minus the accumulated depreciation. And now we're going to ask, how do we calculate accumulated depreciation? Accumulated depreciation. Let me see if I get it here for you. So they look at a computer's book value. The year that the computer was bought. Let me just get the example here. Right, so the very first year, depreciation declines each year, right? So the accumulated depreciation, the amount of depreciation cannot ever exceed the acquisition's cost, less its residual value. So the amount of depreciation that's accumulated over the years cannot exceed that figure. So we're looking at the figure here in, sorry, this is, so we first need to get the accumulated depreciation. So the item costs $35,000. So the first year, its book value is $35,000. There is no depreciation. And we have to go double, or over the double declining method is double, which is 2 over the number of years of useful life of the item. So the first year of depreciation expense will be $14,000. All right, it will be 2 over 5 multiplied by $35,000 to give you 14,000. For the next year, it will be your book value would be your accumulated depreciation subtracted from your acquisition cost, and your acquisition cost was $35,000. And your third year, your accumulated your book value, sorry, would be your accumulated depreciation from the year before subtracted from the um, acquisition cost of $35,000. So 22,000 minus 35,000 will give you 12,600. It looks complex. I wish I had a board that we could have used to calculate this, to give you a better appreciation of how this is calculated. But please go through the example here. Please go through it. And if you have any questions, we can discuss it next week. It might look a little complex, but just go through it. Read through the PDF that is there, and I will send this lecture to you as well. And it's very easy. We will do some practice examples as well, and you see how easy it is. So, and finally, finally, depreciation method is used for financial versus tax accounting. And remember earlier in our the lecture before, in your inventory costing methods, we talk about reporting on inventory and how it can affect your financial reports. Now, similarly, depreciation is another way in which you can use to alter your financial reports. Just give me 1 minute. Yeah. So depreciation expense can be presented in a manner that can favorably forecast the strength and the sustainability of the business. Now, remember, as I said earlier, your inventory costing methods, your last in, first out, that also can make for favorable for reporting of your financial data. All right. So financial versus tax accounting. Remember, financial accounting is where you want to ensure that your company looks good, robust, strong, great revenue, great income. And tax accounting is where you are calculating how much tax you need to be paying to the government, and no one wants to be calculating to pay unnecessarily extra tax. And all of this, as I said earlier, is within the remit and within the guidance of the laws for accounting purposes. So we did a lot today. We went through conflict management. We went through inventory costing methods and financial statements. The latter two being things that you would not be too familiar with. I urge you to go through, read them, take your time and read them. Do some group work. I urge you to do group work as well. Join yourself into some groups and review the material, review the video. Send me questions. You could send me questions either directly or on the group. I will answer to the best of my ability. And apply yourself at it. It might be new information, but I'm sure you all are brilliant enough to read through the material and understand what is being read, understand what you're looking at in the video. think about applying it to real life scenarios. Okay. So, any questions for me, guys, before we close off today's lectures? Any questions? No questions from anyone? No questions about your exam this evening? What time is your exam this evening? Can someone respond and tell me what time is the exam? Okay, Tracy, no questions. What time is the exam? We have, it was a take-home exam and it's due at midnight. Okay, so we get it already. So, so tell me something. So you all, if this is something that you could do on your own time, that means you have all the opportunity to have your books right there and to write the answers, right? You mean the assignment? Yes, Marie. I think someone remember I submitted 2 questions for you all to do as an assignment, and I saw Dr. Maraj gave you all a little review as well on the impact of coronavirus on the economy. So that's those things constitute. So the moment I started to talk about exam, everybody commenting, everybody writing. Students and exams. Exams are not the end of the be all and end all. And yes, it's the means in which you're gonna get your grades and pass. But so well, if so, Marie, okay. So you all use your books, I hope, and your lectures. I hope that you all score really well in the exam because you have a great opportunity to do well. Okay. Yes, Dylan, the exam I'm talking about was the coursework. So um there was going to be one more. Now I use the book value. Reese, what is that you're talking about? Use book value for the exam or book value for depreciation? Reese, answer me that one. Um, so there would be another coursework coming up. It may be we are in today is the 13th, so it may be at the end of the month. Actually, it might be before. It might be either next week. Next week would be. Let me see, because I was told teaching has to stop. So yes, we might actually have an exam and the second course assessment for the 27th. I will confirm that with you. Yes, Reese, now use the book value depreciation. Okay, good. All right, got it. So any questions for me about lectures today? Any at all? Sarah Ramkumar saying when it's due. I saw someone said it's due at midnight. Yes, Biana, it's an assignment. The second in course is the third. Oh, Dr. Maraj confirmed that already, that it being the third? Because I know you the third. Okay. All right. Well, we have some time still. Okay, good. Right. No problem. All right, Dylan. All right, Lebs, thank you very much. So you all have a great evening, and I'll see most of you tomorrow and on Wednesday for community and institutional. So have a great evening. Bye. See you all.